Good morning, ladies and gentlemen. Welcome to today's virtual non-deal roadshow. My name is Nadine Salonga, virtual event moderator here at Renmark Financial Communications. On behalf of our team, we want to thank everyone in Boston and surrounding areas for joining us today for the presentation of Silver Crown Royalties, trading on the CBOE under the ticker symbol SCRI, and on the OTCQX under the ticker symbol SLCRF. Presenting today is Peter Burris, founder, chairman, and chief executive officer. With that being said, I will now hand over the floor to Peter.
Thank you, everybody from Boston area for joining us today. I'm going to talk about Silver Crown Royalties, royalty company, obviously, as the name implies, focused on silver. But before I get into that, I'll tell you a little bit about myself, because probably most people on the show here have not met me before or know very little about me. So I'm a mining engineer by background, by which I mean I went to school for engineering. I spent a couple of years in industry, specifically at the Dome mine in Timmins, which recently has re-entered the news cycle through Discovery Silver's acquisition of that particular asset, and Tony McCooch running that company. So it's back in the news. But late 90s, early 2000s, I transferred over into finance. And specifically, I was on the research side, and I would cover gold companies and precious metals companies, base metal companies, essentially natural resources, hard rock extractive industries. I also spent some time managing money with Kevin McLean at Century. That was in the late 2000s. And, that was through one of the bigger bull runs that we've seen in gold up until that point in time, when gold went from, after the global financial crisis, about 700, 650 to just over 1900. And we've recently obviously had another gold bull run that's peaked out just over 4,200 now, a little bit of a consolidation stage. My latest stint in research was with Canaccord, where I covered royalty companies, I covered base metal companies, I covered silver companies. So all that kind of put itself together and gave rise to Silver Crown Royalties. I started founding companies and putting companies together about 10 years ago, and been in the entrepreneurial side of the mining business over that time frame. Silver Crown Royalties itself was founded about 3-4 years ago now. We went public just over a year ago in July of last year. And I can now say that we've raised all the money that we need to get to free cash flow positive. And I could not have said that at any point in time prior to this month. So very important milestone for us to have achieved, and I'll get into that in a minute. So why Silver Crown Royalties, and more specifically, why silver? So what we found looking at the investment space, the biggest issue for us was, and really a problem that we wanted to solve, was that our dollars simply through time were being eroded in terms of purchasing power. So why silver? Why precious metals? Why focus on that part of the mining space, if not the commodity space in general? It is because, and I say here, it maintains purchasing power through time. And that's absolutely true. So if you look at the US dollar relative to silver, it's devalued by 4% a year on average since 1913. And in the last 25 years, it's actually devalued at 9% per year. So grocery prices, house prices, stock prices appreciate by at least that amount, at least in our mind. And what we wanted to do is protect our savings by getting exposure to precious metals. But for us, the issue was, and this is why Silver Crown, we really couldn't find in industry a company that was easy to invest in without being an expert in the space, or having a lot of experience managing money, or really understanding companies inside and out, knowing how to read a balance sheet, all these things. And again, through our experience, we thought, we could do that, but there simply was not a company in our mind that was the best fit to get exposure to precious metals, to preserve the purchasing power of our savings through exposure to precious metals. We simply couldn't see a company or a company type that would outperform the metal itself through the cycle, with one exception, and that was royalty companies. So royalty companies through the cycle tend to outperform the metal itself. And that's what I show in this chart here. This is Wheaton Precious Metals, also known as Silver Wheaton. This was a streaming company that started in 2005. I know it says 2004 here. So 2004. And as you can see here, this gray line that I'm pointing at, the share price outperformed the price of the precious metal that the company represented by a factor of almost 15 times. On the flip side of that, you have this gray line here that kind of looks like it tracks zero. Well, it's actually somewhat negative, and that's Newmont, one of the biggest gold producers. That's the Newmont share price divided by the price of gold. So what we're trying to show in this graph is that royalty companies tend to outperform simply a buy and hold strategy for the precious metals, whereas a mining operator does not through the cycle. Now, there are exceptions, and I'm happy to address that, but in general, senior companies, because of capital allocation practices and competition, tend to not be able to keep up with the precious metal itself, whereas royalty companies, which are very high margin businesses, do. And Goldcorp itself in absolute terms, so obviously this includes that dollar devaluation that I talked about, was able to return a 30% annualized, sorry, I know it says 30% stake, but if you do the math on this particular chart, it's about 30%, 28% annualized return. Another example of this is Franco-Nevada. If we look at Franco 1982 to 2002, so this is before Franco came out of Newmont in 2008. This is the first iteration of Franco-Nevada. Well, if you invested in Franco in the early 1980s, you would have generated a 40%, 41% return annually. And again, this includes the devaluation of the dollar. So Franco was able to generate an excess return of 30+% a year, which is phenomenal performance. So you can understand why we really, really like royalty companies. So in terms of silver, one key difference between silver and gold for us, and why we focused on silver, is that in the gold space, there already are a lot of royalty companies. I just named two, Silver Wheaton and Franco-Nevada. Well, there's a dozen more easily in the precious metals royalty space that are majority gold focused. There are no silver royalty companies. We're the only one. So not necessarily that there isn't any competition in the silver space, but there's a lot less of it. So we figured if we launch a company that's a pure silver royalty company, we should have, at least in the early stages, a bit of an advantage. So what we do, for those on the line that don't know what a royalty company is, essentially we take fiat paper money at the front end and we purchase a portion of the silver production from a mine for as long as that mine exists. And that includes whether or not it's operating. We would end up owning the silver that's in the ground. As it comes out, it would come back to us. But if it's not coming out, we still own it in the ground. So essentially, we're taking paper money and turning it into silver that comes back to us over future years. That's not necessarily a different approach from the other royalty companies. However, what we've done is we've incorporated certain features that we noticed through our 25 plus years in the business that perhaps would make sense to layer in. And one of them is we look at royalties as individual business units. A lot of times royalty companies will look at royalties and look at them as options. They will think, well, this is a great project. There's going to be many more ounces added to it. It's going to grow. So we want exposure to it. So we'll take a 2% net smelter royalty on this project. And as they find additional ounces, well, that 2% royalty will accrue those additional ounces that are discovered. Well, for us, if we're going to be putting money into the mine or into the company, we would like to see the money come back to us. So what we've instituted is minimum delivery obligations, whereby the company that we partner with, at a minimum, would return to us a certain number of ounces over a certain amount of time. And what this allows us to do is to not only look at mining projects, but also refineries, recycling facilities, autoclaves, etc. So in the silver space, about 15% of the silver that's produced annually, 150 million ounces, comes from recycling facilities. And because recycling facilities don't have any reserves or resources, that exploration optionality does not exist. Well, that doesn't bother us because even though exploration optionality is phenomenal, and don't get me wrong, we love having exposure to exploration projects, but we can now take a look at recyclers, for instance, and we can generate a return by doing a royalty or some form of investment with them. So unlike in the gold space where most of the focus is on mines primarily, we can now look beyond just mines and look at various types of infrastructure projects. And we've done a deal, we've done a transaction on infrastructure, and it's one in our portfolio already. There's a number of other features that we've implemented, like incentives, for instance, because at the end of the day, we want Silver Crown royalties to be a yield product. We want to pay a dividend, and ultimately that dividend should be inflation adjusted, meaning that if you get $1 in dividends this year, it should buy you $1 worth of stuff in 50 years. So we want this to be a yield product. So ultimately we want companies to return that investment that we gave them to us plus some form of interest. And we're targeting 25-30% rates of return. I understand that may seem high. However, if we look at certain types of cost of capital, especially for natural resource projects, it's actually reasonable. Now, having said all that, the incentives that we're trying to put in front of our partners, in front of the mining companies that we transact with, will include things like finding additional ounces, increasing production or increasing throughput, getting permits, funding a project to production, building an extra mill, things like this. And for each one of these types of milestones, we would then pay them additional capital or equity in Silver Crown in order to, again, incentivize them to generate higher returns for us and to go from exploration or development into production and actually generate that cash so that we can get it back and pay it out to our investors and our shareholders. So what we've done so far, again, I mentioned, this is a very young company, only been public for a year. So it really in 2023, when we did our first transaction, that's when we really started to get going. We raised about $17 million in our existence. The latest was just over $3 million that we closed October 6th this year, so a couple of weeks ago, about a month ago. And we are now in a position to get to free cash flow without having to raise any additional capital. And that was the reason why we went public a year ago, was so that we could get access to the markets, get enough cash so that we could fulfill our financial obligations to our partners, close the deals that we had tabled and papered up, which we have now done. And now, as our partners continue to drive towards production, increasing production, doing their expansions, etc., we fully expect to receive from them enough silver payments to be free cash flow positive. Not this time next year, in fact, Q2 next year. These are the silver ounces that we would expect to generate going forward. So 2005 is this year, 2026 next year, obviously. So somewhere in the neighborhood of 30,000 ounces this year, 70,000 ounces next year. And again, at 70,000 ounces, we would generate roughly $3 to $4 million in free cash flow Canadian. Also on this chart, as you can see from 22, 23, 24, obviously when you start from zero, the growth rate is very aggressive. So that put us into a position to be one of the fastest growing, actually the fastest growing companies by revenue in the natural resource space. If one were to use the Bloomberg EQS function with these parameters, we would come in at the top. The location of our assets, we do get asked this question. Do we look at tier 1, tier 2, tier 3 jurisdictions? Right now, again, until we get to free cash flow positive, we're focusing on North and South America. Ultimately, because of our diversification strategy, once we're free cash flow positive and we have enough free cash flow, we will deploy capital into other places. However, we're very cognizant how much as a percentage of our total capital deployed we will put into any given project, number one. And number two, the riskier the project, the higher the return we would seek. So we could go into a high risk area, but we would not put in more than, say, 1% of our invested capital. And we will be looking for returns that are 50% plus, as opposed to the 25-30% that we look for right now. And speaking of 25-30%, well, the transactions that we've done so far, I know the first one, it says 15%. That was our first deal. However, we did that at $18 silver. Now with silver at 45, the IR on this transaction would be north of 30, no problem. Overall, right now, if we were to use $45 silver, the IR or the transactions that we've closed would probably be closer to 40% overall on average. Using the prices at the time of the transactions, if we were to average all of these, we would end up somewhere in the 25-26% area, which again is in that target rate that we look for, 25 to 30%. Unfortunately, this slide is a little out of date. I apologize for that, but we do have 3.8 million shares outstanding now. Again, that's because of the financing that we closed recently. So our market cap right now, turning my head, I'm checking, is 22.9 million Canadian. So very much a nano cap company, very early stage. This is essentially ground floor entry. Some of the key components here, the founders round was done at $1. So there's no penny stock, nickel stock, dime stock here. $1 stock, that's where the founders came in. Seed round was at $4. So the average cost base of all the financings that we've done right now is about $6.50. And we're trading at 605 bids. So very reasonable in that regard. Now, when it comes to our supporters, institutions, we have Adrian Day at Euro Pacific. He has about 250,000 shares. And we have US Global. They have about 120, 130,000 shares. Retail is a big component, but there are some very sticky buyers, or diamond hands, some people call them. So about 60% of the retail pie is concentrated in very tight holdings. So when it comes to the float, maybe 35, 40% of the company's share base, again, 3.8 million shares, is free trading, readily available. Now with the life offering that we did, that added another 600,000 shares. So that's, possibly, I estimate half of that would be readily available as well. And when it comes to valuing companies such as royalty companies, and again, I'm leaning back a little bit on my experience as an analyst from a number of years ago when I did cover royalty companies. For companies that don't have free cash flow like ourselves right this minute, a price to sales multiple is not an unreasonable thing to use. And I know that it might be controversial, but if we think about it, royalty companies, especially ones that do have free cash flow, well, because the margins are so high, a price to sales multiple will be very close to a price to free cash flow, or even EV to free cash flow multiple. So if you look at the seniors and if we look at the juniors, I guess, 1 billion plus, 10 billion plus market cap companies, they trade between 20, 25 times sales. But, and it's not on here, the free cash flow, because again, the nano cap, micro cap companies don't have it, but it's about 25 times, 30 times free cash flow. So if you look at the nano caps and the micro caps, they trade around 25, 20 times sales. So if we were to do the 70,000 ounces for next year, for instance, at $45, that would get us, in terms of US dollars, roughly 3 million in revenues. And in Canadian dollars, that would be roughly 4.4 million. So at 4.4 million times 20, that's 88 million. And we have just around 4 million shares outstanding. So, you can draw your own conclusion as to where the stock may trade. However, and I've not mentioned this in prior presentations simply because the stock was correctly reflecting our past performance. But again, we didn't have the cash runway to get us to free cash flow positive, which we do now. So I believe that once we do get to free cash flow Q2 next year, could be even Q1 next year, depending on the performance of certain assets. But once we do get there, and again, we don't have to raise any more money to get there, the stock should re-rate. And in my mind, based on these comparables, we should trade somewhere in the neighborhood of $12 to $20. And with that, I will take questions.
Thank you for the presentation, Peter. And as you mentioned, it's time for question and answer session. So your first question from a viewer is, with royalties so fiercely competitive, do you envision more small caps copying the Silver Crown method?
It is possible. However, there's two key differentiating factors here. And I'll focus on one of them. And this is the minimum delivery component, which anybody can use, and that's fine. But because of the origin of all royalty companies And I mentioned Franco in 1982 really was the first one in hard rock royalties. The focus really has always been on exploration optionality and reserves and resources. The interesting thing with silver is we estimate that half of all the silver that is produced globally is not reported in terms of technical reports or in terms of financial updates by various companies. And I'll give you an example of this. Osisko. When Osisko put Canadian Malartic into production, they didn't report any silver. There was no silver in the resource or in the reserves. And this is because that project was discovered sometime in the 30s and operated until the 60s. So the resources never included silver because they didn't have to. Polymetallic mines that produce copper and gold and lead zinc will always produce silver. Geologists knew that, metallurgists knew that. And because it was such a small economic component, nobody really had to, spend the money because they knew they were going to get paid on it anyway. Long story short, what I'm trying to get at is that because the silver is not reported, very few, well, actually, no, all the royalty companies can only do transactions if the reserves and resources are reported. And so far, they haven't pivoted, they haven't shifted yet because they've been telling their investors the whole time that it's all about exploration optionality. Well, there's no exploration optionality on a recycling facility, for instance. So until that pivot happens, we don't expect any fierce competition. Ultimately, when we do get big enough, we would expect that to change because 25, 30% IRRs are very attractive to anyone. But because we do create our own royalties, and that's another thing where the competition doesn't exist, anybody that's less than $1 billion market cap, I'm trying to think here. Yeah, nobody under $1 billion market cap has created their own royalty. Every single company that's out there right now simply bought royalties that already existed, or a producer had royalties on their balance sheet. The royalty company bought them, or the royalty company was used as a vehicle to take those royalties public. And that goes through, doesn't matter if it was a private equity fund or if it was company XYZ gold producer. These are all existing royalties. There's no such thing as a silver royalty, again, because these are all polymetallic. So if we want a silver only royalty, we have to create it. And so far, nobody's doing that.
Outside of the final tranche of the Igor 4 royalty, how are you allocating the remaining proceeds from the latest financing?
So we parked some of it in silver, only because we feel that as a silver royalty company, people entrust us with their capital to, not hold it in a bank, which is, again, what we created this company for, is to be an alternative to having your savings in a bank account where you're guaranteed to lose 4 or 5% a year, including interest payments. So we allocate some of that capital to silver. Once we do advance some of our pipeline discussions far enough to, definitive agreements, et cetera, and it comes to deploy that capital, we're more than happy to obviously flip that silver out into cheaper silver from future production from various mines. But that's what we've done right now, is we parked roughly half of the cash that we have not deployed in silver. And I believe that puts us, I like to make the joke that we now have more silver than the Canadian government, which is absolutely true. But we also have more physical now with SilverCrest out of the equation. We now have more physical on our balance sheet than any producer that I know of, but certainly any royalty company.
What silver price sensitivity has management assumed in its internal budgeting, base case or downside/upside? How would a prolonged lower silver price environment affect acquiring new royalties or existing royalty payments?
So the way that we look at silver prices is we just use 12-month trailing silver price. That's what we use in our forecast. That's what we use when we do our 25, 30% IRR deals. When we go talk to various companies, that's what we table. That may be a little bit more aggressive than what companies would use in 43-101 calculations, et cetera, but there are sensitivities that are built into all these things as well. How do we think silver prices will perform through the cycle? What we do is, because we use the 12-month trailing, we believe that it really doesn't matter if silver prices average $50 over a year, then we'll use $50. If they average $20, we'll use 20. So over time, over 10, 15 years, that average should always trend toward that 25, 30% IRR if we take the highs and the lows and average them out over that time frame. So as long as we stay disciplined there, and as long as we don't start doing deals that are 5% IR or 0% IR, and really only become a vehicle that is a leveraged investment to the metal price, which frankly, I think that's kind of pointless. Just go buy futures in the market. So, we just have to stay disciplined with those returns, and hopefully that continues.
There's lots of coverage on countries buying gold. What can you tell us about government silver purchases?
Very little. The reason why governments purchase gold, in my mind anyway, is because, well, gold is, in terms of mass, worth 85-ish more than silver. So you would need 85 times more storage for the same dollar amount of silver than you would for gold. So gold is a lot easier to store. The other thing with silver is there just is not that much of it readily available above ground. It does have many more industrial applications as a percentage of annual output than gold does. So with gold, you're going to end up 80% of gold that is mined ends up going to a vault. With silver, it's probably 20%, if that. And again, you have so much more of it in terms of storage space, in terms of dollar value. It just makes much more sense for central banks to purchase gold. So we've been hearing about that. Now, I've actually given this quite a lot of thought, because in my mind, gold prices, one of the drivers behind the gold price and relative outperformance of gold, especially against silver, especially against copper, was central bank purchases over the last 2.5 years. Prior to that, central bank purchases were more or less trending the same rate that they have been for the past 15, 20 years, but they certainly picked up over the last 2 years. I think that in part, everything still reflects US dollar devaluation, which has only accelerated over the last couple of years. So whether or not central banks pick up more silver, whether or not they have been, again, that's very difficult to gauge simply because physical silver is in such tight supply. But whether or not they pick it up or not, I don't think it will really have that much of an impact on the silver price. And I believe that what will continue to drive silver prices beyond dollar devaluation is the ongoing deficit in terms of production versus, i.e. supply versus demand. And I mean, in silver, really, it is consumption. For instance, solar panels, that silver doesn't come back until silver's over $100 per ounce. It makes no sense to recycle the panels. There's various other factors that I can talk about, but bottom line is, you're looking at about a $200 million deficit in silver in the last 5 years, and I don't see that dissipating anytime soon. So the same pressures that are pushing gold higher are going to be the same ones that are continuously pushing the silver price higher. And I don't think you need central bank purchases in order to take silver to, $100, $200 per ounce.
What happens if there is a default from any of the streams?
So usually what we've done is we've been, very forthcoming, try to be on the level with the producer, try to help them. So if there's a default, the payment accrues and there's interest charged on it. And eventually when the mine comes back, is either restarted or there's financing that comes in, that default can be settled. We have not pursued any kind of legal means in terms of try to reinforce payment or try to get it back or anything. We try to work with our partners to essentially get them off the mat. And then once they're back up and running, we're good to go. Now, one of the ways that we protect our investors and ourselves from defaults, and look, it's mining, things do happen, and there's circumstances beyond anybody's control. Project can be going really well one day and then something happens and it shuts down. We've seen that at Cobre Panama, just as a for instance, and that had nothing to do with technical anything or financial. It was simply a political decision. So these things do happen. What we do is we limit the amount of capital exposure, not only in terms of how much of our invested capital we put into any single given project, but also through staged payments, how much we put into any given royalty as a percentage of total. So if a project is just getting off the ground, they don't get 100% of the capital that we're going to put in. Maybe they get 25 or 30% or 50%, but they don't get the full thing. So just in case there is a default or anything else like that, then we haven't deployed the entirety of the capital. However, because it is a royalty, it does stay on title and it does survive any kind of bankruptcy, any kind of restructuring. So we've layered in certain ways to protect our investors. Another one, for instance, as well, is we will set up joint accounts that will be prepaid in anticipation of a high risk situation. There may be a default. Well, now there's a prepayment. Maybe it's 1 quarter, maybe it's 2 quarters. So we can cover the missed payments through that facility. So there are certain things that we put in anticipating such developments. But we always try to work with our partners to get them through the tough times so that we can both succeed at the other end of the tunnel.
What return thresholds or deal economics does Silver Crown require before originating or purchasing a royalty? For example, IRR hurdle, payback period, reserve life? Are you prioritizing producing royalties versus near-term development royalties?
I'll start with the very end. Until we're free cash flow positive, we're absolutely focused on cash generating royalties. And we will continue to be focused. Probably 70% of our invested capital is going to go into something that's in production right now. 20%, 25% will go into something that's going to be in production within 3 years. And 5% will go into exploration, which is 10, 15, 20 years out. And that's probably going to get tightened up anyway. And again, because we use these incentives, we really try to get the non-producers to get into production as quickly as possible, as efficiently as possible, so that we do get that cash flow from those projects. So cash flow for us will always be focused, and it's always going to be more than 50%. Like I said, 70% plus of invested capital is going to go into something that's producing right now. Or if it's a facility, perhaps, it can be producing within 6 months just because it's a turnkey operation and maybe they just need some capital in addition to what they already have to finish construction, something like that. So it's a case-by-case basis. In terms of returns, because we don't buy royalties that already exist, because we create them, we can make the returns be not necessarily what we want, but we can make the returns be what makes sense for both companies. Now, this is really good because if the company and us can't come to terms, if they want a 10% IRR, really good for them, not so good for our investors, well, we don't have to do the deal. We don't have a gun to our head that says, oh, you have to grow at a certain rate, otherwise something will happen. Nothing will happen, right? So we're not going to destroy our investors' capital by putting it into deals that don't make financial sense, that are not accretive. So if we can negotiate what we think makes sense for our investors, we simply walk away. And we've done that in the past. There are 2 transactions that we walked away from because they didn't make economic sense to our investors. So our hurdle right now is about 13%. That's what we estimate our cost of capital to be. So we want 25, 30% IRRs. Could we go as low as 20? It's a situation by situation thing. If I can get a 100-year asset and I can get guaranteed deliveries for 25 years, and it's safe jurisdiction, and it's been in production for 10 years, and it ticks all the boxes, maybe 20% makes sense. It's still a 7% margin above our investors' cost of capital, our cost of capital. Obviously, still want to target the 25, 30% range, so that would be offset by perhaps perceived more risky assets, but certainly higher return assets. But that's generally what we want to trend toward. And right now, I think, is the right time to do it because, look, nobody knows what tomorrow will bring. Maybe some competitor shows up. Maybe somebody says, oh, I can do exactly the same thing as that guy. And look, there's no patents on these things. So it comes down to really having those relationships over the last 25 years, knowing where these assets are, being willing to monetize silver that's not reported or in 43-101s, things like this that allow us to do what we're doing. Is that going to change in the future? Who knows? So we got to, make hay while the sun shines.
Are there covenants, milestone payments, or contingent liabilities tied to any of the royalty purchases that could create future cash obligations? If yes,
No.
Are you able to provide the amounts and timing?
No, we're very cognizant of that. So we never want to be in a cash call position. So all the future deployments are equity based. And what that means is that, company XYZ, we do a deal with them. It's for $10 million, $2 million up front, $8 million milestone payments. Those $8 million in milestone payments would be done in Silver Crown equity at certain dollar per share prices. So if they do meet that milestone, we issue them equity from Treasury. They can then use that equity to borrow against. Stock is marginable, so it actually is almost like money, and off they go. So there's no cash obligations from our end. And yeah, we learned that lesson dealing with another company that we launched. But yeah, it was a lesson well learned, and every additional obligation that we have can be satisfied with Treasury issues.
What catalyst will allow you to outperform silver?
I mean, that's the nature of royalties. We pay less for the silver that comes back than what the market price is. And, if you're doing 25, 30% IRR deals, you're paying 3 to 4 times sales. So 3 to 4 times sales is whatever the market price of silver divided by 3 or divided by 4 is. So we're essentially paying $10, $15 per ounce silver that comes back to us. So it's that margin that allows us to outperform the metal price itself, which allows us to grow the company. So instead of just buying a brick of silver, it's never going to be 2 bricks. It's never going to pay a dividend. Whereas if you buy Silver Crown, it can be 2 bricks of silver and it can pay a dividend. And that's the differentiating factor, is the capital deployment is being done with those returns in mind. And that's what makes investing in something that is a company, that is a managed company, where there is a decision process about capital deployment. That's the differentiating factor between just buying and holding that commodity. And, again, back to the graph that I shared with the Silver Wheaton and Newmont on it, you can see royalty companies add value relative to the metal price, whereas producers have a very tough time doing so.
Is there a region of the world that has had more understanding or warmth to this style of deals?
Well, we've approached Australians, and they were quite receptive, but we haven't been able to do anything there yet. Definitely North America is very receptive to these types of deal structures, and companies listed in Canada, obviously, a lot of them are natural resource companies. There's about 4,500 companies listed in Canada that are natural resource based, and a lot of that is hard rock mining. So they're quite receptive, and that's where we've had most of our success. Not to say that we're not reaching out to other parts of the world, but there's a lot of business to keep us busy in North America.
Are there any upcoming project additions expected to close before year end 2025? I know there are quite a few LOIs.
Yeah, there are, but it's an iterative process. So we learned our lesson. We're not going to announce letters of intent unless they're legally binding or unless we have a definitive agreement at hand. So, yes, there are things that are being worked on. Would I like to close another deal, especially a cash flowing one, before the end of the quarter? Absolutely. Is that going to happen? Well, I'm not going to make any promises because, I don't want to be that guy, the over-promise, under-deliver. We've seen way too much management like that in the industry. So, I'd much rather be cautious. But here's the thing. Again, just looking at what we already have in hand and that free cash flow that we now have visibility to is more than enough to justify an increase in the share price. So anything over and above that would just be gravy. And yeah, absolutely, I would like to see that. Now, another way for me to answer that question with that graph that I had there, I would like to see our silver ounces double every year. So if we're doing 30 this year, we should do 60 next year. We should do 120 the year after, 240 the year after, things like that. So double the silver base that's coming to us every year. That's what I would like to see. We've been averaging roughly 1 deal every 6 months. So, perhaps that helps answer that question.
How do you determine whether a royalty deal is accretive?
Again, it has to have the returns that are higher than our cost of capital. That's what accretive is. So again, our cost of capital is about 13%. Anything above that would be accretive. Anything below that is destructive.
What percent of silver comes from recycling per annum?
About 15%, 1.5. So the silver market annually produces about 1 billion ounces of silver. 150 million ounces comes from recycling facilities. What happens there is that it's essentially an aggregator that puts together circuit boards and used electronics, post-consumer electronic waste, and then sells it to a third-party dealer or trader. Could be Ocean Partners, could be Trafigura, could be one of these guys, and then ends up going to a smelter. And it's the smelters that then tell us exactly how much silver came from what, because the smelters, they get obviously concentrates from mines, so we know how much comes from mine production, and they get this blend material, which is post-consumer electronic waste, so they can tell us, okay, this much silver, this much gold, this much stuff came from this source, this much came from this source. So that's how we know those numbers. And that's reported, I think, by the Silver Institute.
Will the company consider streaming or hybrid structures, such as advance payments and smaller perpetual royalty, to conserve cash?
We would. We would also contemplate syndicating actual royalty deals, because I mentioned, nano-cap, micro-cap royalty companies only deal with existing royalties. Well, if we were to create a royalty, then it would already exist and we could bring in a partner on that. Would we consider streams? Absolutely. But, we prefer royalties simply because royalties are tied to title. And it's just this, extra level of protection for our investors. Streams themselves being a debt instrument or a debt equivalent instrument, while we've seen those get restructured, we've seen them not necessarily lose the access to the material, but we did see them be restructured when the stream was deemed to be economically burdensome. We haven't seen that in the royalty space, and that's why we prefer royalties. But no, on a case-by-case basis, of course, yeah, we would contemplate these kinds of things.
What is your G&A?
So if we include our marketing budget, which is $250,000, and if we include everything in terms of cash outlays, it's 1.1 million Canadian, right? And that includes all the cash salaries. It includes market maker, D&O insurance. It includes payments to Odyssey and SIBO. It includes all that stuff. It's 1.1 million Canadian. That's the input that I use when I estimate free cash flow, right? So I take the revenues, whatever they may be, looking at $45 silver perhaps, times whatever number of ounces we would expect for next year. So I'll give you a range, 40 at the low end, could be as high as 100 at the high end. So whatever number you want to pick from that, subtract 1.1 million, and that's your free cash flow. Should we be paying any taxes next year? That's debatable, but if you want to be conservative, throw in a 26.5% corporate tax rate, and there's your free cash flow on the other side of that.
Thank you so much, Peter, for answering our viewers' questions. If you did not get a chance to submit your questions, you can reach out to the appropriate account manager here at Renmark. That concludes our presentation today. But before we go, I will turn it back to Peter for final remarks.
Thank you, everybody, for tuning in today. And don't hesitate to reach out if you have any additional questions. silvercrownroyalties.com is a great source for additional information. This video will be posted on there. There's a lot of other resources on that website and a way to get in touch with us as well. Email addresses, phone numbers, etc. silvercrownroyalties.com. Thank you.
Once again, this was Silver Crown Royalties, trading on the CBOE under the ticker symbol SCRI, and on the OTCQX under the ticker symbol SLCRF. Thank you to everyone in Boston and surrounding areas for joining us today. Stay tuned for other presentations in your area, and see you next time.